All right, let's dive right into this explainer and decode the mechanics of the small business vehicle deduction. If you're a small business owner, you already know this is one of the most frequently claimed, yet most frequently mishandled deductions out there. So, we're going to explore the framework to get it right from the exact moment of purchase so you can maximize your benefits while completely avoiding an IRS audit. Remember, getting the structure right can mean a substantial deduction that really supports your growing business. But getting it wrong, well, that can lead to denied deductions and some pretty harsh penalties. Here is our roadmap for today. We're going to cover 1, the statutory framework, 2, expense methods, 3, vehicle types, 4, phase downs and recapture, 5, the mileage log, and finally, 6, the bottom line. Let's get to it. Section 1, the IRS statutory framework, the basic rules. To build a solid foundation, we first have to understand the specific Internal Revenue Code sections that basically act as the laws of physics for vehicle deductions. You don't need to be a lawyer, but knowing these codes is your absolute baseline for compliance. So under Section 179, you have this potential to just expense the cost of qualifying property right up front, in the very first year you put it in service. It's way better than slowly depreciating it over a decade, right? It's a huge tool for us small business owners, but you gotta remember, it's strictly subject to annual caps and business income limits. You can't just write off the moon. There are real boundaries here. Building right on top of that is Section 168. Now, this section governs MACRS, the Modified Accelerated Cost Recovery System. And crucially, this includes the super popular bonus depreciation rules, which let you deduct a specific percentage of the vehicle's cost in year 1. Though, spoiler alert, as we'll see in a minute, that percentage is actually kind of a moving target right now. And then we have Section 274. Think of this as your ultimate audit shield. It strictly dictates exactly how you have to prove and record your vehicle use. See, vehicles are considered listed property under the code, and Section 274D lays out the hardcore record-keeping rules you absolutely have to follow. Honestly, without this, Sections 179 and 168 mean literally nothing to an auditor looking at your file. Moving on to Section 2, Decision 1, Expense Methods, the first fork in the road. Now that we know the rules, let's look at the first major structural choice every self-employed taxpayer has to make when putting a business vehicle in service. You essentially have 2 paths, and you must choose one. It's super interesting to compare the simplicity of the standard mileage rate against the nitty-gritty tracking of the actual expense method. Standard mileage is set every year by the IRS. It's 67 cents a mile for 2024 and bumping up to 70 cents in 2025. And that one rate covers the whole shebang. Gas, repairs, insurance, wear and tear, you just multiply your business miles by that rate and boom, you're done. On the flip side, the actual expense method means you meticulously track every single cost. But the massive trade-off, it's what actually allows you to unlock that MACRS depreciation and Section 179 expensing. But listen, you gotta choose your year 1 method very, very carefully. Why? Because of the lock-in rule. If you go with the actual expense method and use MACRS depreciation in year 1, you are permanently locked into that method for the entire life of that specific vehicle in your business. It's a one-way door, folks. If you start with standard mileage, you actually keep the flexibility to switch later on. But actual expense, that is forever. All right, Section 3, Decision 2, Vehicle Types, the weight classification. Let's move to our second major decision, where a tiny detail on a door jamb sticker can completely alter your tax classification. This is arguably the most consequential structural choice you'll make right on the dealership lot. Okay, 6,000. That number is your absolute heavy hitter threshold. We're talking specifically about the GVWR, the gross vehicle weight rating. Now keep in mind, this is not the curb weight of the car. It's the fully loaded rating you'll find printed right there on the manufacturer's sticker inside the driver's side door. And believe it or not, this one single number completely dictates your deduction limits. Buying a vehicle even slightly over 6,000 pounds classifies it as a heavy vehicle, and that unlocks some significantly different expensing rules. Heavy SUVs and trucks over that threshold get to play with much higher Section 179 limits and remaining bonus depreciation. But passenger autos under 6,000 pounds, they get heavily capped by the Section 280F luxury auto rules, meaning your first-year deduction on a lighter vehicle is strictly capped, no matter how much cash you actually dropped on it. Which brings us to Section 4, Phase Downs and Recapture, Navigating the Traps. Having structured our purchase and made those big choices, we really need to examine the dark side of vehicle deductions, shrinking timelines, and the dangerous recapture trap. It's not all just upfront write-offs. There are real strings attached. Look at this timeline. Section 168K bonus depreciation is aggressively phasing down year by year. It was 80% in 2023, dropped to 60% in 2024. It hits 40% in 2025, down to 20% in 2026, and unless Congress steps in, it's zeroing out entirely by 2027. Basically, your deduction math is constantly shifting depending on the exact year you place the car in service. That instant write-off strategy just isn't the same beast today as it was a couple of years ago. And guys, here is a massive hazard, the recapture trap. Say you completely max out your Section 179 and bonus depreciation on a big, heavy SUV in year one, claiming 80% business use. Great, right? Well, if 2 years later your business habits change and you dip below 50% business use, the IRS will literally force you to recapture that excess prior depreciation and treat it as ordinary income. Yeah, it's a hugely costly, unexpected tax bill that catches so many small business owners totally off guard. Let's look at Section 5, the Audit Defensible Mileage Log, the ultimate shield. So to protect everything we've built so far, let's explore the single most critical operational habit for your business. You can have the best strategy in the world, but it falls completely apart without this. Under Section 274D, your contemporaneous records, meaning logged right when it happens, must rigorously document 4 exact things every single time you drive for work. Step 1, the mileage for the trip. Step 2, the exact date. Step 3, the specific business purpose. And Step 4, the destination. You can use a smartphone app, a dusty paper logbook in the glove box, or a spreadsheet, but you absolutely have to track this in real time. Because let me tell you, failing to keep that real-time log is the absolute biggest audit issue with vehicle deductions. Sitting down and reconstructing your mileage from memory in December, that's a massive fail. You also got to watch out for other common traps. Are you missing W-2 adjustments for personal use? Did you accidentally count a family member's daily commute? Remember, commuting is always personal. Other huge mistakes are illegally mixing up the standard versus actual methods in year 2, or trying to claim Section 179 on a leased vehicle. You can't depreciate a car you don't actually own. A lease only lets you deduct the business use percentage of the lease payments.
All right, wrapping up with Section 6, crucial steps and bottom line, bringing it together.
Okay, let's pull all these structural, rules, decisions, and compliance factors together into our final actionable takeaway. Because we've got all these wild moving parts, like GVWR, Section 179 caps, luxury limits, and phase downs, they really require expert coordination. So consulting your tax professional is an absolutely mandatory first step. Please, do not wait until tax time to try and untangle this. Always consult your tax pro before buying a vehicle with a business deduction strategy in mind. You really want to get this right from day one. So take a really hard look at your current mileage logs and how your vehicles are classified. And ask yourself, are you truly audit ready for this tax year? Is your business vehicle strategy built on a solid foundation, or is it just a fragile guess? Don't let an amazing, totally legal deduction turn into an absolute audit nightmare. Get your records straight, talk to your professional, and drive your business forward with confidence. Thanks for joining me on this explainer, and keep learning.